Is the market ready for a deeper pullback? As we just closed our second day in the red in the S&P 500, as well as at the day's lows, no less. Now there are still some bearish divergences in the charts, and we have a huge week of data ahead. So today we're going to discuss key levels that need to hold for the bulls or break for the bears to get that pullback we've been looking for. Hello ladies and gentlemen, welcome to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell. Let's get into it. Looking at the heat map today, guys, we can see the biggest standout is definitely Google here, down 4.21%. There's a lot of internal struggles happening in Google. This led most of the mega caps to the downside. Look at Microsoft, look at Apple, look at Meta. Nvidia and Tesla were the only green participants in the mega cap 7 today, but a pretty red day across the board. The real standout winner was software application right here, as well as semiconductors. This part in infrastructure did do pretty good on the back of PanW and Adobe. Consumer defenses, Walmart, Costco put up a green day, but across the board, red day. I think if most of your money wasn't in like software application or semis, your portfolio is probably red on the day. Now this is the S&P 500 chart, and we could see here that we were down 0.38% in the S&P 500, pretty much flat here in the Nasdaq, mid caps as well, and then the S&P 600 put up a pretty flat day across the board, but a lot of the pain being felt in the S&P 500, and the RSP down negative 0.4%. So the broader market did decline, and there was a whole range of things going on today. It was price discovery waiting on PCE, the GDP data. We saw rates actually did tick up ever so slightly. And something that's really interesting, Bitcoin up 7% for the day. So Bitcoin outperforming the market as a whole, but zooming into the S&P 500 and what trade looked like on the day. So we saw this red candle, a bit of follow through after Friday's red candle. So we did gap up Friday's sell off, and the sell off did continue. We closed at the low of the day, and that's not constructive at all for price action. Now there is a gap here at the 49.80 area that is still open, and we can actually afford to pull back all the way to this area and look for buy side opportunities. And in fact, the only time we should actually really get worried about this chart breaking down, on the daily at least, is if we look at 49.44. Up until this area right here, then we can look for sell side, but as long as we're above this area, we can look for dip buying opportunities, look for strength in the tape to take us higher. And especially if we do go ahead and close this gap, make a low right here, that would actually be a higher low in comparison to this and this, as well as this, and that would be very constructive for higher price action in the future, and then we can actually go take out these levels. But all in all, this does not look too constructive for the bulls at the current moment, and we do need to find a place, a bottom per se, where the S&P 500 will go and put that in, so we can look for dip buying opportunities. Do you remember that we are in the window of weakness until Thursday, potentially Friday? So up until then, we could actually, to see downside, to see selling pressure is not out of the ordinary. Now looking at sectors, and we could see here the best performing sectors was obviously software, semiconductors. Metals and mining actually did a pretty good job, followed by XLE. Besides like tech, no real winner in terms of all the other sectors that were up there. A few beat the SPY, about half lost against the SPY, but all in all a pretty red day in the S&P 500. Down 0.037%. The weekend poll just wrapped up. Thank you to all 545 of you who voted. If you want to take part in these, go ahead, subscribe to me, and you can take part in next week's poll. Now, there's no conviction in this trade. 50% of you believe the next 100 points in the S&P 500 is going to be up, and the other 50 believe it's going to be down. So no real conviction here in this week. Yesterday, we had about 64% of you said price was going to move lower, and the S&P 500 finished like 1.15% for the week. So this still tends to be a contrarian indicator. Whatever side has the highest votes, generally take the opposite. But in a 50-50 scenario, it's going to be really interesting to see what pans out. I'd be really interested to see the stats because we've never had a 50-50 trade in the weekend poll. Now, just to track back to earnings, guys. So we had a fairly alright day. We had iRobot, Himsa's Workday, and Zoom. They all reported earnings. Berkshire Hathaway as well, but we covered that in the weekend video, as well as Domino's Pizza. But we're going to look at Zoom. The reason why is during this 2021 rally, I held a lot of Zoom shares, common stock, and they absolutely rallied all the way up, and I made quite a lot of money on Zoom in 2021. So I do like to keep track of it. I'm not in the position anymore, and I actually did sell it well before I should have. I think I sold it at like $450. It ran up like another $100 before it had that massive sell. But yeah, let's actually have a look at Zoom earnings. It was up 10% in after hours trade. The market definitely did like the earnings, and they posted a 2.6 increase in revenue for the quarter, of 1.146 million or 1.1 billion, and that's 4.527 billion, a 3.1% increase year over year. Net income, they posted net income just under $300 million and non-GAAP net income of $444 million. Q4 operating cash flow of $351.2 million, and for the financial year that's $1.598 million, and they're now authorized to repurchase $1.5 billion worth of stock. Now, looking at trades we could be taking for the next quarter, this is some very interesting stats. So this is when the December to February quarter is greater than 2.5% and accompanied by an all-time high in February. This has only happened 17 times, and the 3 months after that, the first quarter after the end of February, has a perfect record, 17 wins, 0 losses, average return 5.09%. The full year is 16-1, only 1 loss, 15.57% return. And it gets really interesting. If you cross out 1987, the only year there was a loss, you can actually see that we don't get much of a drawdown at all. In every single case, excluding 1987, every single drawdown was no more than 10%. But the draw up was absolutely crazy. So we get these shallow drawdowns and then returns in excess of 15%. Absolutely crazy statistics, right? And it just goes to show that momentum brings momentum. Now, one of the reasons why this tends to happen is because when we do get all-time highs, it shows that probably stocks are fundamentally sound, and stocks do well if earnings are doing well. And right now for calendar year 2024, we are expecting earnings growth of 10.9%. Now, normally when we do get like earnings like this for the full year, they do tend to get revised quite a lot. This is the historical revision trend. So they get revised down. So, analysts will pick a number, and normally at the end of it, they'll be revised down up to 6.3%. So let's say analysts predict 16%. At the end of that, we could probably only get 10% earnings. Right now, we are trending well above the historical average. And I think that's simply because earnings are coming in a lot better than expected for Q3, and analysts are starting to even revise up for 2024. So we're going to see where this goes. We do have to keep track of earnings revision trend, but if we do follow this path right here, we could only get like a 3% down, maybe 1.4% from where we are, and we might even just get maybe like 9%, possibly 10% full year earnings in the S&P 500. So very interesting to see that consensus revisions are above the historical trend. And that's because the economy is actually doing really, really well. You can see here that GDP data, we got GDP data from Goldman Sachs, and both are right here. And GDP data for 2023 Q3 is tracking at 3.3%. You can see the same is true right here. Now, the forecasts for Q1 do diverge. Both are predict 1% GDP in Q1. Goldman Sachs is predicting 2.4%. Now, we do get GDP data later on this week. If you go to the end of the video, I normally put data in the week ahead, so you guys can go ahead and have a look at that. But as we can see right now, GDP, at least the consensus and the forecast, seems to be tracking 1% and above. Now we're going to see who's right or who's wrong. And just something to note, the Fed's GDP now is actually tracking at 2.9%. So, it's tracking more in line with Goldman Sachs prediction versus BofA's prediction. So just something to go about there. But I'd love to see where this estimate is at the end of this week. Now, what did that do for rates? You can see that we are still expecting to hold at the 525 to 550 level in March, and the first cut only coming in June. And it seems like the market has moved away from when are the cuts happening to they are happening in 2024, and let's begin to rally on that. I do think that even if cuts do get moved out to, this July period, September period, I think the market's not going to care much for it as long as we're getting these cuts in 2024. And generally speaking, that was the sentiment from Fed speakers last week, saying that we probably will get cuts in 2024. And so the market seems to like that. Now let's actually talk about what that does for markets now. And we can actually see here that we have this amazing data from Goldman. And it's pretty much like, what do FMS investors believe Fed policy will be doing with regards to cutting rates? So are they cutting rates because of a recession? Is it to adjust the yield curve on a deep basis or on a shallow basis? Or are they going to hike or no cuts? And what we're starting to see here is that hike or no cuts is starting to move up, especially as we've moved cuts out from March into May, into June. We can see here that, recession cuts have gone down the ladder, and deep adjustment cuts, shallow adjustment cuts have sort of like come down and increased significantly. And this is very, very interesting because you can actually see here that equities tend to rally further after the first rate cut when easing is driven by monetary policy normalization. And this is the green line right here. It's pretty much in track with this blue line. And when we cut rates to ease policy, we normally go on these extended rallies. And with the economy being as good as it is right now, real Fed funds the real cost of credit is too high. And so the Fed will be cutting rates to normalize the cost of credit. And we should generally get a very, very strong rally after the Fed cuts rates. But we can also see that we generally do tend to rally into the Fed cut as well. It does get a bit grim if we do end up with a recession or some form of a growth scare. But normally when the economy is good, we get rate cuts, equities tend to go on pretty violent rallies. And you can see a 2-year returns 40% plus. Insane. Absolutely insane. Now, geopolitics and government debt deficit spending continue to be the biggest risks to equities. And I would agree 100%. What is also scary is that a credit shock, a credit event is almost not really a risk factor, at least according to advisors. It'd be really interesting to see what happens with CRE regional banks, especially since the market is not pricing in that type of an event. Now looking at the JEX chart, 5100 continues to be the core gamma resistance strike. We're not seeing any movement up. We're actually seeing expansion of the strike as well, which is very weird. And that's going to probably hinder the markets, because if we don't move up, that probably means we're going to have a lot of price discovery at this 5100 area, a little bit above, a little bit below, but markets don't tend to travel quite a bit above the core gamma resistance strike. So it'll need to move up if the market does want to move higher. But that being said, we are still in the window of weakness. Technically, still a lot of negative gamma in the tape, but much more positive gamma. 49.65 continues to be this gamma flip zone, and I will eye actually opportunities to buy if we do get to this zone, because if there is bull demand right here on a technical basis, that actually is a great place to buy. Now guys, the window of weakness is coming to an end on Thursday, Friday. That's when Van and charms start to have effects again in the market, and then for the next 1, 2, and 3 weeks we'll be in the window of strength, I guess. Van and charm flows are at the strongest. Bears had the opportunity to take the market lower and they simply couldn't. Yeah, so from next week we're out of the window of weakness, and then we should have 2 to 3 weeks of pretty strong dealer supportive flows in the market. Now let's have a look at some charts. So this is the S&P 500 election cycle, what we normally return and what we're actually doing right now. And you can see that we've just rallied pretty much from the first day of January all the way up, and we've pretty much brought forward all of the election cycle gains for the full year. Now this doesn't really matter. Trend is more important than the actual level, and you can actually see here that based on where we are right now, we normally would see some form of consolidation. So if we do actually consolidate here for a good couple of weeks, that's to be expected. Maybe even pull back. Again, 100% expected. But all in all, we have come quite a long way. And seasonally, we should see a little bit of a pullback, especially in this March period. Based on how fundamentally sound everything is, if we just keep going higher, do expect that too. But that being said, just looking at this, you can definitely see that, we're not really following seasonality in any way, shape, or form. Now, this is the S&P 1500 breadth dashboard, and you can see that pretty much in all of these sectors right here, stocks are not just at their all-time highs, but a large percentage of stocks are approaching 10-day highs, 20-day highs, 63-day highs, 6-month highs, 1-year highs, and you can see it across the board. Now, do take this with a tiny grain of salt. Technology right here, I think these stats might be a bit off. That being said, we are seeing new highs being made constantly in stocks, and as long as stocks are making new highs at an index level, higher highs will be made. At the same time, we can also see right here that new lows, there's virtually no new lows. I mean, sure, comm services in very specific industries, as well as real estate and utilities, but other than that, virtually no stocks across the board are at 10-day lows, 20-day lows, 60-day lows, 6-month lows, 1-year lows. So very healthy momentum. And if you really do want to see stocks make substantial lows, you really want to see new lows breadth, this tick up. You want to see all of this redness in all of these boxes. That's really what you want to see as a bear if you do want that sustained pullback to lower levels, especially approaching 10% correction territory or 20% bear market territory. That's what you want to look for. And this data is telling us that stocks are probably going to move higher, which means sectors are going to move higher, which means indices are going to move higher. Now, adding on to what I said before, having a look at very specific sectors, you can see that semiconductors, all these charts are moving to the right. While they may not be in the top right hand corner, you got to look at the trend. Semiconductors all-time highs, moving higher, right? Same thing with small caps. We can actually see here that this moving average is finally moving up compared to what it's done over the last 12, 18 months. Look at the transportation index. It's moving up as well. Look at biotech, strong rally right here in biotech, and it looks like it's moving up as well. The same thing with steel, retail. Banks are looking a little grim at this point right here. However, still a fantastic rally off the lows from banks, and then home builders as well. Actually, home builders looking almost as strong as semiconductors at these highs. All of these sectors are telling us that stuff like semiconductors, transports, home builders, the economy, banks, small caps as well, retail. The economy is looking good in the lens of stocks, according to these charts. Now, this is the core leadership model of Grant Hawkridge, and you could see that generally speaking, when we are in strong leadership, which is above this green line right here, but generally bullish as long as you're above the zero line, we're not just approaching strong leadership, and you can actually see that we're moving back into this strong leadership trade right here. We did pull back a little bit, but we're getting up there. And normally what happens is when we do get into this phase of extremely strong leadership, sure, we can go in there, come out, go in, come out. But when we do, we go on like sustained rallies that tend to last quite a while. And you can see that this right here, this might actually just get, this leadership model, we might actually see a sustained rally and higher highs all the way to like 53, 5400, at least according to the stats right here. Now, this is the core market model, and you can see that we're not even at extreme overbought levels. We're just overbought in the S&P 500 right now, but being overbought doesn't mean you have to sell. Sometimes you can stay overbought for very long periods of time. And as long as we're above, again, this zero mark right here, it is a bullish indicator, it is a bullish sign. Now, this is the bellwether stock index, and it just includes all of these stocks right here. You can actually see that we made all-time highs in this index, broke above this high right here, and this is really bullish. These stocks represent, the baseline of the economy. And if this chart is doing really, really well, stocks as a whole will do really, really well. It means the economy is doing really, really well. Now, I got a couple of trade ideas for you guys. The first one is Adobe, guys. So we had a pretty significant sell-off in Adobe. We're finding support at this level right here. What I would look for, now some people would say we went and made a lower low. Personally, I think this is the significant low because we had this strong rally. That being said, we actually didn't go ahead and break this level, and this does look for a good trade. If we can maybe like pull back, retest, and then go up, that's going to be awesome. What I'm really looking for trade this week in Adobe is sort of like a pullback here and then move up. Don't break the 531 level. If we can go ahead and do that, that's looking strong. Might even put in like a little higher low here, pull back, move up, and then we can actually go ahead and break these highs here at 640 in Adobe. Great stock, and also just like a fantastic stock to add and hold in your portfolio. Another one is Palo Alto Networks. We could see that we had a huge gap down after earnings. We sort of like found support at this level right here, and it does look like we are moving higher. Very similar situation to Adobe. Maybe we get a pullback into this level, look for higher price action, go ahead, close this gap right here. And this isn't like a 1 week or 2 week trade. This will probably be like a full quarter, maybe even more. Some of the losses we've seen, go ahead, close that gap in Pan W or Palo Alto. Now, data in the week ahead, guys. The major focus will be on personal income outlays, GDP, and then University of Michigan sentiment. You guys can have a look at it here. Very interesting, a dense week of earnings and data as a whole. We also have quite a number of Fed speakers, Bostic, Collins, Williams. They're all giving their takes, and we really have to keep an eye on these just to see what the sentiment is looking like inside the Fed and what they are thinking about. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, guys. Like this video. Cheers.